All right, let's get into it. We're going to take a look at what's been happening with gold lately, but this isn't your typical market story. There's something else going on here, something kind of hidden just below the surface. So today, we're basically putting on our detective hats to solve what I'm calling the case of the deceptive gold bounce.
So you look at the chart and you see it's climbing. The headlines are all buzzing about it. Gold is definitely making a move. And that brings us right to the heart of our investigation today. Is this bounce a real deal golden opportunity for buyers, or is it actually a very, very clever golden trap?
To crack any case, you've got to start with the obvious stuff first, right? So let's begin by unpacking the surface narrative, the story that pretty much everyone is seeing and hearing, before we start digging for the clues that are hidden underneath.
And bam, right away, you see the problem. This slide shows two completely different stories being told by the exact same price move. On the one hand, you have what most people are probably thinking, hey, a bullish recovery, this is a great chance to buy in. But on the other hand, you have the insider's view, which is basically the total opposite. This isn't a recovery, this is the bait for a perfect trap. The real move down, well, that's just getting started.
So this huge conflict in perception, it really forces us to look a little deeper, doesn't it? We have to go beyond just the simple up and down on a price chart. We've got to ask ourselves, is what we're seeing actually just a deceptive illusion? Okay, so here's the core theory we're working with. The overall big picture trend for gold is actually bearish, meaning it's headed down. So this little bounce we're seeing, it's not a sign of new strength, it's what's called a retracement. Think of it like the market pulling back just for a moment, pushing the price up into a premium selling zone. It's almost like it's offering a great price one last time, making it the perfect spot for the big players to sell before the next major leg down.
Now, to prove a theory like this, we can't just rely on one piece of evidence. We have to really crack the market's code. And to do that, we're going to use 4 totally different analytical lenses. It's kind of like a forensics team examining a crime scene from every single angle you can think of. And here they are, our 4 lenses. We're going to start with the psychology driving the move, then we'll look for structural clues on the chart, then we'll ask if it has any real value, and finally we'll zoom way out to see the bigger economic picture. So let's jump in with number 1.
Our first lens is all about psychology, and it's based on a concept from George Soros called reflexivity. The idea is actually pretty wild. It says that market prices don't just reflect reality, they can actually create reality. In other words, if you can get enough people to believe the price is going up, their buying can actually cause it to go up, for a little while anyway.
And this is exactly how that whole idea is being used here. This bounce is the psychological bait. It is designed from the ground up to look just like a recovery, which of course gets retail traders feeling bullish and eager to buy. But according to this analysis, it's really just tactical deception. The real goal is to get everyone to have an emotional buy reaction right before the trap snaps shut.
Okay, on to our second lens. Now we're going to look at the technical structure of the chart itself. You can think of this approach like a kind of financial archaeology. We're literally looking for the footprints that the smart money leaves behind. We're hunting for clues like imbalances in the order books, things called fair value gaps, which can show us exactly where the big institutions have been making their moves.
And when you look, the structural clues are all pointing in the same direction. The analysis shows that the big picture trend has already flipped bearish. So this bounce, it's not a new trend. It's just a move back up to an area that was priced inefficiently. That fair value gap we just talked about, sitting right around that 4280 to 4300 level. This is seen as a golden opportunity for institutions to sell off their positions at a really good price before the next expected drop. All right, for our third lens, we're going to try to channel a bit of Warren Buffett. Let's just strip away the chart, forget the psychology, and ask one really simple question. Does this price move even make sense? Is there any real-world, fundamental economic reason for gold to be rallying right now?
And the verdict on that? It's a pretty clear no. From a pure value perspective, this move seems to be floating on nothing but emotion. The analysis finds 0 solid macro justification for a sustained rally, which means it's basically an emotional mispricing. It's a move based on feelings, not on financial facts. For our fourth and final lens, we're going to zoom all the way out. This perspective looks at the entire financial system as a whole. How do huge things like the strength of the US dollar, interest rates, and the overall fear in the market affect the price of gold? Are the big currents of the system helping gold right now, or are they fighting against it?
And when you look at the big picture, it becomes crystal clear. gold is facing some major headwinds, not tailwinds. A strong US dollar makes gold more expensive for anyone buying with other currencies. Rising bond yields give investors a safer, more attractive place to put their money. And a low VIX, which is the market's fear index, shows that there isn't a lot of panic driving people to the safety of gold. The macro environment just isn't there to support a big rally.
So we've looked at the evidence through 4 completely different lenses. Now it's time to assemble all the clues and reveal the full picture of what this analysis is calling the smart money trap. All 4 of our lenses keep pointing to this one specific price window, 4280 to 4300. This is not just some random number. It's the point where all of our evidence converges. It's the fair value gap from our structural analysis, and it's the premium selling zone. The analysis identifies this as the trap zone, the precise area where this whole trap is designed to be sprung.
And here is the trigger. If the price breaks decisively below this 4220 level, that would be the confirmation. According to this framework, that's the point of no return. It's the signal that the trap has worked and that the buyers who jumped in on that bounce are now caught, which could fuel a really sharp move lower.
So this slide basically pulls all that analysis together into a testable hypothesis. You've got the entry in our trap zone, a stop loss set at a specific point where the theory would be proven wrong, and then potential price targets if the whole thing plays out. Now, it's really important to see this not as a prediction, but as the logical conclusion that's been drawn from our 4-lens investigation.
So what's the big takeaway here? I mean, whether you're a serious trader or just someone who likes to watch the markets, there is a massive lesson in all of this about the difference between a real, genuine trend and a carefully manufactured trap.
This quote from the source material just sums it all up perfectly. This move is not trend, it's trap. It goes on to describe it as a manufactured event designed purely to attract buyers so that larger players can rebalance their own bearish positions before the next potential move down.
And this really leads us to the ultimate takeaway, which is kind of mind-blowing. The most sophisticated players in any market, they aren't just trying to predict the future. A lot of the time, they are actively engineering it. By manipulating price, they can influence belief. And by influencing belief, they can create the exact market conditions they are already positioned to profit from.
So I'll leave you with this to think about. After seeing how a simple little bounce can be taken apart and revealed as a potential trap, the next time you see what looks like a sure thing in the market, what kind of questions are you going to ask yourself before you just believe the surface story?
And of course, it is absolutely essential to remember that this entire breakdown has been for educational purposes only. It's a synthesis of a few different analytical frameworks, and it's really just intended to make you think, not to be taken as financial advice. Please always do your own research.